You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another year of OIC's Wide World of Options. I'm your host, Mark Benzaquen, and I'm excited to bring another year of options education provided by seasoned option professionals like myself and my colleagues here at OIC. Typically, a new year is often accompanied by New Year's resolutions, and for many of us, this might include the typical fare of adopting a healthier lifestyle or learning a new skill. For me, it'll be the usual get more exercise, eat more salad mantra, though I've also added in learning to play guitar for 2023, so I'm pretty excited about that. For others, they might decide to take a more active role in their finances and planning for their retirement. And for many of those, that includes learning about options. So if you're one of those people, well, you've come to the right place. OIC was created more than 30 years ago as an industry resource designed to educate investors as to the risks and rewards of trading exchange-listed options. And to that end, our investor education team speaks with individual investors and financial advisors daily about pricing, volatility, corporate actions and their impact on options, for example, and a whole lot more. But like acquiring any new skill, you've got to first learn to walk before you can run. And learning about options is no different, as each concept is built on the understanding of the previous one. So with that in mind, we're going to start at the beginning and go from there. So to begin with, options are contracts, and like all contracts, they bestow certain rights and obligations on both buyers and sellers. For example, buyers have the right, but not the obligation to buy or sell the underlying security, which may be shares of stock, an ETF, a cash-settled index, for example. Buyers have the right to buy or sell that underlying security at a specific price known as the strike price and within a specific period of time. Option sellers, on the other hand, have the obligation to buy or sell that underlying security at the strike price and within that expiration date if assigned, which is a concept that we'll get into in just a little bit. So prior to options being introduced in 1972, investors basically had two choices when it came to investing in stock. If they were bullish, they could buy the stock and hope that the share prices increased. Or if they were bearish, they might sell the stock short and hope for decreasing share prices. If share prices remained flat or traded within a narrow range, for example, their investment would lack profitability. So the investment really didn't go anywhere. However, with the invention of options or the introduction of options, investors have new ways to potentially capitalize on their bullish, bearish, or even market neutral forecasts, which isn't something that was possible prior to options. And they can do that through the buying or selling of calls and puts. And capitalize they did, as recent record-setting volumes seem to indicate. So in a word, options offer investors flexibility that they can't find through only buying or selling stock. So I said we were going to start at the beginning, and let's do just that. There are two types of options, and those being calls and puts. For equity or ETF options, buying or selling calls and puts results in the physical transfer of the underlying stock, typically 100 shares, and that occurs between the buyer and seller. There are also two types of option settlement styles, American and European. So for an American style equity call buyer, for example, they have the right to purchase 100 shares of stock in exchange for paying the strike price on or before the expiration date and taking delivery of the shares. For an American style equity put buyer, they've got the right to sell 100 shares of stock in exchange for collecting their strike price on or before expiration and delivering those shares. So a call buyer has the right to purchase stock at the strike price. The put buyer has the right to sell stock at the strike price. The process by which this exchange of cash and stock occurs is called exercise, which again is something that we will discuss a little bit later in this podcast. And conversely, option sellers therefore have the obligation to fulfill the terms of the contract, which entails either buying or selling stock in exchange for that strike price through the process of assignment. Whereas buyers and sellers of European style contracts can only exercise and or be assigned on expiration date. So let's look at a brief example of what I'm talking about here. Let's assume that an investor is bullish on stock XYZ and anticipates share price increases beyond the current price of $100, where it's trading in the open market. Traditionally, they might simply choose to buy 100 shares of stock outright and pay $10,000 for the 100 shares, or they may decide to use options instead and theoretically control the same 100 shares, but at a reduced price. We should note that owning call options and owning stock are not the same thing, as stockholders do enjoy certain rights not available to option holders, namely voting rights and the right to be paid dividends, if any. However, by exercising those call contracts, the option holder now becomes a stockholder, along with all the risks and rewards that go hand in hand of being long stock. So, okay, enough of that. Let's get back to the example. So let's assume that rather than paying $10,000 and buying the stock outright, our investor decides to purchase the 100 strike call, expiring in 30 days for a cost of $2.30. I should note that as each option typically has a multiplier of 100, the $2.30 paid in that premium represents an investment of $230 per contract. So the investor can either spend $10,000 today to buy 100 shares or spend $230 for the right to purchase $10,000 worth of stock over the next 30 days. If share prices drop below the $100 strike price, the investor will likely elect to let the contract expire without value, and they lose their $230 investment. So, for example, if stock finished 30 days later when the contract expires and the share price is now $90, the stockholder would lose $10 on their 100 shares or $1,000 overall, where the call holder, because the contract finished what we would call out of the money, the call holder would lose their investment of $230. If stock closed at $110 on expiration, the call holder would likely exercise their contract and take delivery of 100 shares of stock at $100 per share, or they might simply sell the call back to the market to close the position, and their profit or loss would be the difference between the $2.30 paid when initiating the trade and the premium collected when selling to close out that position. So speaking of premium, let's shift gears for a second and discuss the cost of options. An options premium has two components, intrinsic value and extrinsic value. Intrinsic value is simply the positive difference between the underlying share price and the strike price of the option. So for example, with stock trading for $55, the right to purchase shares at $52 would inherently or intrinsically be worth $3. So a $52 call would have a $3 intrinsic value with stock trading 55. If stock were trading 60, the call would then have $8 of intrinsic value. Extrinsic value is any portion of the premium over and above the intrinsic amount. So with stock trading 55, if our $52 call were trading for $5 in option premium, $3 of the premium would be attributed to the intrinsic value as the option is in the money by $3. That's the intrinsic amount. And the remaining $2 would be deemed extrinsic value. And though we'll explore the concept of pricing more thoroughly next month when I welcome my colleague Ken Keating to discuss options pricing, extrinsic value, which is more commonly referred to as time value, represents the opportunity for potential changes in pricing and the various pricing components until the option contract expires. We're all familiar with the saying, time is money, and never has that been more applicable than with options pricing. So think of a stock that you're familiar with and ask yourself where that stock might be trading by the end of today's session, or what might the trading range be by the end of tomorrow's trading session. While it's likely you won't be 100% correct, it does stand to reason that you might be able to at least ballpark a trading range with some degree of certainty, right? Now, think about where that stock might be 2 weeks from now, or 2 months from now, or even 2 years from now. Not so easy, is it? So looking at it from a seller's perspective, would you be comfortable obligating yourself to selling stock at a specific price today and delivering those shares 2 years down the road? Who knows where the market might be at that time? And for that reason, long-term options command higher prices than their short-term counterparts, as sellers are able to dictate higher prices due to pricing uncertainty and increased risk. So, and again, in other words, time is money. So speaking of sellers, that premium that they collect represents the maximum profit sellers can expect from selling options. On the other hand, that same premium represents the maximum loss for option buyers. So in our previous example of purchasing a $52 call for $5, that $5 represents the maximum loss for the buyer, or $500 of investment dollars, and also indicates the maximum gain for the option seller. Of course, paying $5 for the right to purchase stock at $52 realistically means buying stock for $57 a share, as the premium paid must be taken into account when considering the trade. This is where we get our break-even point, which is the point at which investors begin to make or lose money on the trade, not including any commissions or fees. Though break-even is calculated differently depending on the strategy, for straight buy or sell orders, break-even is calculated by adding or subtracting the premium from the strike price. So if we buy a $75 strike put for $3 and sell our stock at the strike price of $75, we're really selling it at $72 because we paid $3 for that right to sell stock at $75. If we sell a call with a strike price of $100 and collect $2 for the sale, we're effectively selling those shares for $102, right? Because we sold that stock at $100, but we also collected an extra $2, which is in our pocket from selling that option. So that's where the concept of break-even comes into play, the point at which investors begin to profit or lose money on the trade. And though I can talk about options for hours on end, which is probably why I don't get invited to too many parties, our time today is coming to a close, and I want to talk about the process of turning those rights and obligations into a concrete reality. And that's where the exercise and assignment process comes into play. Exercise is the process by which a call or put holder, otherwise known as a buyer, turns their equity or options contract into physical shares of stock. Typically, this is only done if the contract has at least 1 penny worth of value at expiration, though buyers of American-style contracts can exercise their options, again, at any time for any reason. If the contract has at least 1 penny worth of intrinsic value, that contract is said to be in the money. In the money contracts at expiration are usually exercised automatically through what's known as automatic exercise. The result is that for calls, the strike price times 100, which again is the multiplier, would be debited from your trading account, and you would then be credited with the 100 shares of the underlying stock. For puts, you would be credited with cash from the strike price times 100 and debited 100 shares of stock. If you don't already own those shares to deliver, then you would need to either buy them in the open market or arrange to borrow them from your broker. Once exercised, your broker will then notify OCC, the clearinghouse for all listed options in the U.S. OCC will then randomly assign your exercise notice to an OCC member firm, who will then assign the notice to an investor with an assignable position. So for a call seller who receives the assignment notice, the stock would be debited from their account, and their account would then be credited with the cash from the sale of the shares. For put sellers, they would buy the stock assigned to them in exchange for their strike price. So for a put seller, they would be credited the cash from the sale of the shares and debited the shares from their account. For more information on exercise and assignment and your trading firm's specific policies, you'll want to reach out to your firm direct to see how your account might be affected. And that brings a close to today's podcast. So a big thank you to all of our listeners and supporters out there. Before we sign off, I want to invite each of you to register for my upcoming OIC webinar, which will take a deeper dive into the basics of options and the fundamental concepts all investors should know, complete with downloadable slides to better help you visualize the concepts that we discussed here today, as well as a few others. You can register on OIC's website at www.optionseducation.org to attend the live presentation or to view it on demand as well. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening, and we'll be talking with you again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.